and you'll see I opened up 6 different, 1, 2, 3, 4, 5 positions today. They were all opening trades, and they were all short premium trades. I mean, I was a seller of options. So we'll sort these kind of from earliest in the day towards the latest of the day. I opened up my day with two strangles, two undefined risk trades, one strangle here in XOP. If we check that one out and go into duplicate mode, you'll see it was a $7 wide strangle outside the expected move of XOP. XOP is the oil and gas exploration and production ETF. So it's an oil and gas ETF basically. Had a lot of good volatility in that. You see up in the 42nd rank, which means that on a scale of 1 to 100, it was almost midway there in implied volatility from the last 12 months. And if we look at the stock price here, you can see it's been very choppy. So I could pick a direction here, but as I stare at this, I don't know what I would choose. I don't know where it's going to go, and I'm pretty sure you don't know either, which is totally okay. That's why we trade options. So a good old-fashioned strangle was the ticket on that guy. One thing here is, you might be wondering why so many trades today. Well, it's really at that sweet spot in the expiration cycle where that was a 46 days till expiration trade, and research has shown that between 40 and 50 days, averaging right there at 45 days till expiration, is really the best time for a consistent profit per day and P&L per day. A lot goes into that, which we'll talk about in future segments, but that 45-day is really when I want to get the guns out and start shooting and get some positions on the board for that cycle. The next trade here was USO. So we go into the curve view here. You can see a couple really nice things here. So what I want to do is also show you when you're placing trades. This is something that not a lot of people know about within the within the platform here. Is if you click on this volume and stock, it'll give you a very small chart here. I don't think I can really zoom in much more than this on the screen, but what this does is it'll actually highlight the positions that you've selected, the strike prices you've selected on a chart that you can kind of see. This is over from April to June, so it's probably a 12-month chart there. There it is, 52-week chart. And it'll kind of give you an idea of your profitability range using historical data there to guide you. But anyways, the USO trade here, this is one that I like to put on. It's one of my bread and butter trades simply because USO is such a low price security. It's only a $13 stock, so it doesn't make a ton of sense not to get in on this position. And I'll show you why here in just a second. So it's a $99 maximum profit on this trade, but if we look at the buying power reduction, it's only reducing my buying power by $265 for placing that trade. What that means is that you have an extremely good risk to reward ratio on my on this trade here. For undefined risk trades, it's not uncommon for you to only have about a 10%, maybe 8% return on investment. Here, you're pushing 33% return on investment for this trade. So it definitely makes sense to fit in on your portfolio. It's one that you can easily scale up because let's say you wanted to have $1,000 per trade in your position sizing. You could put 2 or 3 of these guys on pretty much no problem. The second reason why I like this trade so much is because USO moves around quite a bit. It's nice to have one of these neutral trades on that you can simply roll out in time if you're wrong. So as the option contract goes on in time, if you get to that maybe 10, 15 days out till expiration, you might want to consider rolling that trade out to the next expiration cycle. What that does is it gives you more time, and as this security has shown, it's going to go up, it's going to go down. You don't know when, you don't necessarily know how far, how much it's going to, but you can pretty well bet that it's going to go up and down over time. And so by being able to kind of just buy yourself more time, get yourself more duration on the trade, you have a much higher likelihood of profitability in that position. So that's a good one to have on. Moving on down, if you don't know yet, you will find out shortly. I'm a dad of 2 girls and a baby boy at this point. So having Disney in my portfolio is kind of like a necessity because I probably single-handedly increase that stock price over time with the number of figurines and things that I purchase. But anyways, I like to have a position on in Disney, but as you know about me, I don't like to pick direction. And as I look at Disney's stock price and stock chart over the last 52 weeks, I could not tell you if it's going up, down, or staying the same. So for me, a good trade in this position is just your classic iron condor. It's a delta neutral strategy. So basically, and this is a very nice symmetrical strategy. So it's $10 wide between the stock price, between the calls and the puts. It's $10 wide between the short put and the long put. And it's $10 wide between the short call and the long call. What's even nicer about this is kind of the symmetrical nature of the risk. So in most stocks, you find negative skew, which means that the puts trade richer than the calls. And in layman's terms, what that means is there's more risk for a big, crazy crash and more likelihood of kind of a slow upward movement in the stock. So the cost of protection on the downside is much more valuable than the cost of protection on the upside. Hope that explanation makes a little bit of sense. But here, you don't really see that, because if you look at this probability of being out of the money on the short puts, 75%. On the short calls, 74%. Going $10 down again, 2%. $10 up, 3%. So it's a very nice, natural, neutral trade all around. It's one that I like to have in my portfolio. All right, moving on. Trade in Apple. So I placed a lot of trades in individual securities today. I like to stick around ETFs, but there just wasn't a lot of volatility in those products to be able to trade good trades in. So I did kind of go into the single name products. And when you do that, if you're going to be diving into single stocks, especially as a new options trader, definitely recommend you define your risk. You don't want to take undefined risk simply because if you look at these charts, these move around much faster, much quicker than ETFs. You figure the S&P 500 index is an index of 500 securities. Just think about that. So if one stock like Apple goes from 155, what is that, to 180, back down to 165, all the way up to 190, it's doing that over the course of like 3 months. If you take 500 stocks though, 500 securities all together and lump them together and average them out, you basically get the S&P 500. It's much more rare for that major of a market move to happen across all of those securities. So that's one of the reasons why I definitely recommend defining your risk on securities. And I'm a little bit more lax when it comes to ETFs. I'll place many more undefined risk trades in those securities as well. Okay, so similar setup here. I went out here to about the 20 delta, so 85% probability of expiring out of the money, and $10 wide on each side. Another thing that's nice about going, in general, about going $10 out on each side is that you have generally a negative delta in that position. And we'll get into the benefits of why I like negative delta, but I like to carry a little bit of negative delta in my overall portfolio at all given times. So I don't look all the time at my deltas. I like to plant my short strikes at the deltas, but then going out a set number of dollars on either side. That also gives the secondary benefit of efficiency. Whereas, let's look here for a second. If I have $10 on each side, I have a maximum loss of $864. Okay, that's the 136 plus 864 equals the $10. That's $1,000 of risk. But if I drag this guy down to 15, only that one side, I've increased my loss to $13.52, and my profit hasn't gone up that much. But if I move this guy up again to $15, look at this. My risk hasn't gone up at all. It's actually gone down a very slight amount. So when you maintain the same width of your long strikes here, you increase your capital efficiency by a large sum, it can be. So that's that trade there. And then with my Tesla trade, I don't commonly trade Tesla, but given that's where some of the volatility was today, and also, as you'll see here, the statistics make it look like a pretty attractive trade, I wanted to go ahead and dip my toes in the water. So this is a defined risk iron condor. I'm not doing, let's see here. So I'm doing $10 wide on each side, but if you were to remember the Disney trade, let's just go back and just look at the characteristics of Disney. So Disney here was $10 between the shorts and $10 between the longs. So very symmetrical. Let's look now at this Tesla trade. This is $80 between the short strikes and $10 on each side. So it's much tighter of the protection on the long strike side, but look at that range, and there's a very good explanation for why that range is so broad. So this is the movement of the stock price, and in the last year, it's reached a low of 250 and a high of almost pushing $400, and it's right there, kind of smack dab in the middle right now at around $300. So it's got a much more likelihood of taking big moves, taking big risks. So that's why you get paid very well for going out so far. If we look at this risk to reward, we're getting 265 for the 735 that we're risking, which is a pretty good credit received. Now, with all of these iron condors, I look to take about 50% of the maximum possible profit from that trade, and then I'll reestablish the trade the next cycle, the next day, whatever I need to, depending on how the trade sets up at that point. So you can see here, if I'm getting $265 of an initial credit, I'll be looking to take away about $1.30, $1.32 on the profit target there. And if we show you what I mentioned before, if I look at this button right here where it says volume in stock, it'll show me kind of how my iron condor sets up overlaid on the stock price itself. A lot of times I'll go out and I'll get a charting software, or I'll have to kind of draw it all up myself, but it's kind of difficult to do it that way. What's nice about this is that it does it at the point of when you're trying to place the trade. So even though the web platform is starting to show a little bit of age, compared to the newness of the desktop platform, there's some serious benefits, like the workflow here of being able to see your trade as you're placing it overlaid on the stock price. All right, so those are my opening trades of the day. So 5 opening trades, all short premium, looking for 25% on straddles to come out, looking for 50% on my strangles and iron condors to come out. So we'll see. We're really getting into the meat of the July options contract time period. So we'll see how this contract shapes up. Hey guys, thank you so much for watching this video. If you're on YouTube, go ahead and hit the subscribe button and click the little bell to be notified when I make my next video and send it out to you. But even better than that is if you want to have access to me live as I'm recording this and sharing my portfolio and the ups and downs of my options trading journey, go ahead and head on over to optionengineer.com/group and sign up right there to have instant access to my private Facebook group. It's awesome. There's so many great members growing every single day to become better, more profitable, more exciting options traders. So thank you guys so much for checking it out, and I'll see you on the next one. Take care.